Okay, so good afternoon. Uh, g- Good afternoon, and welcome to the Hoperation Fund 2024 year-end report. Mm, Today, I'm just gonna skim over the introduction, talk about the new announcement with our new advisors, go over our portfolio report, market analysis, do an open discussion where we'll share our ETF portfolios, and finally finish off with a finance and investment lecture, number 5. This time it will be about bonds and bond ETFs. And if we have time, we'll do a case study of Warren Buffett's 90-10 portfolio. So, established on May 18, 2023, the Hoperation Fund has two missions to number one, uh, invest capital in the stock market and donate to charities, and number two, to fill educational gaps by equipping students and adults with essential knowledge and skills in personal finance and investing. So we have four main sections: fundraising, investing, donating, and education. And now, let's move on to today's announcement. We have two new advisors, which I will introduce in alphabetical order. First of all is Dan Penley. Mr. Penley is a well-established expert in the algorithmic trading industry with more than 20 years of experience. He stands out for his exceptional ability to combine quantitative expertise with innovative investment strategies and his extensive interest in personal finance. Mm, It is my great honor to welcome him to the Hoperation Fund. So now let's welcome Dan Penley.
Thanks. Hi.
Hey. So Mr. Penley, would you like to give like a quick introduction of yourself?
Sure. Thanks for that intro. I have been in finance for my whole career. I'm fascinated by it. Very interested in investing in stocks. And being a part of Hoperation. I've and most of my experience has been in algorithmic trading, so using computer software to buy and sell various things, whether it's stocks or stock options or stuff like futures, like some more exotic stuff. But I also have a CFA and a lot of experience with fundamental analysis of companies. And personally, that's what I spend a lot of my time doing, and managing my own investments by investing in various stocks and so on. So I'm really looking forward to being involved with this.
Okay, that's great. Thank you, Mr. Penley. I look forward to having you as an adult advisor. So our next adult advisor will be Yan Zhang. Um, Mrs. Zhang traveled to more than 20 countries as an international marketing manager and is a well-established expert in the algorithmic trading industry. She stands out with she wait what? Okay, sorry. I'm so confused. She is a seasoned professional with extensive experience as an international marketing manager, having traveled to over 20 countries and now serving as an analyst in the petroleum exploration industry. Her passion for investing, including her success in finding two 10-bagger stocks, and her dedication to community service led her to the Hoperation Fund. So again, it is an honor to have Mrs. Zhang be an adult advisor for the Hoperation Fund. So now let's welcome Mrs. Zhang. Uh, Is she here? Okay. Uh, so anyways, let's all give a round of applause for Mrs. Zhang and Mr. Penley.
来了来了，
Mm.
那这是
Mrs. Zhang, do you want to give an introduction of yourself? Mm. Okay. Anyways, currently the Hoperation Fund has 54 students from 5th to 11th grade, along with 16 adult members coming from 15 states. So here is a list of our student members and adult members. So thank you all for joining the Hoperation Fund, and I look forward to having a great year.
上来了呀，我也还
In 2000, so now let's move on to talk about our fund growth. In 2024, the Hoperation Fund received $4,835 in public donations and raised an additional $2,315 through a public book club and AI class. The fund's portfolio achieved a 41.3% investment return, generating a profit of about $4,400. Of this profit, 80% will be donated to selected nonprofit organizations. So right now you can see this graph here. This shows our assets under management in 2023 and 2024. You can see we've come a long way from having around $9,300 to having more than $22,800. This right graph also shows the capital for donation. We have in 2023 we only had around $727, and in 2024 we now have had $3,535. So next month we will review our charities and begin to go through the donating process. So speaking of charities, in 2024, our members and advisors have recommended a few candidate nonprofits to receive our donation. So below is the list. The first one, Cancer Kids First, was recommended by Dr. Zhang. The second one, Monarch Watch, was recommended by Heidi Truman. The third, Fungal Diversity Survey, was recommended by Amy Zhang. And the fourth one, the Coral Biobank Alliance, was I researched and searched up and recommended myself. So now let's continue to talk about our investment portfolio. The return in December for the Hoperation Fund was negative 1.83%. So the year-to-date of the Hoperation Fund is now 41.3%. In comparison, SPY and QQ's year-to-dates are only around 25%. Here you can see is a snapshot of the Hoperation Fund portfolio. In December, the portfolio was slightly adjusted. I reduced the number of shares in some positions while increasing the shares in other positions, and the current cash allocation is 16%. So again, here's the comparison of the monthly returns of the Hoperation Fund portfolio, S&P 500 Index Fund, and NASDAQ 100 Index Fund. You can see the total returns since its inception of the Hoperation Fund is 74.5%. In comparison, SPY has had a return of 43.6% and QQQ has had a return of 49% during the same time period. Yeah, thank you, Sebastian. Yeah, that's what I will also talk about later on too. Thank you. So recently, JP Morgan also published an interesting survey. They reported that the average retail investor is up just 3.7% by November 2024. So how is this so? During 2024, SPY has had a return of around 25%. Well, this is because the Hoperation, because while the average retail investor might just like follow some new trends, the Hoperation Fund, we have continually invested in high quality, long-term stocks for investing with strong business models, large free cash flows, high ROE and ROICs, high good fundamentals, etc. And now let's go on to, Mina Shun to everyone said, how's Costco stock? Oh, Costco is a pretty good stock. Costco, personally, I like Costco because I think it's very good for long-term investing too. But also, Costco has really good seasonalities in like November too. Anyways, by the way, if you guys have any specific questions about stocks, you guys can ask me later in the Q&A session after this meeting. Okay, so now let's go on to the market analysis part of today's meeting. So the Hoperation Fund market direction. Okay, the market direction right now, according to a Hoperation Fund criterion, right now the short-term market direction is neutral, the midterm market direction is neutral, and the long-term is still, in my opinion, staying bullish. The short-term market sentiment, according to CNN Fear and Greed Index, is also kind of fearful, as the CNN Fear and Greed Index is now at 32. So what this means is that since the short-term and mid-term market direction are now going from bullish to neutral, I would advise being more cautious, as the stock market right now could in the near future turn either bearish or just revert back to bullish. So I would be a little more cautious and like pay attention to recent news in the market. So for suggested position sizes, I would recommend having around 60 to 80% of stocks, 10 to 30% of cash or bonds, and 5 to 10% of gold. The market valuation right now is also overvalued. The S&P 500 PE ratio is 30.33, but the 10-year treasury yield is 4.6%. So generally, when you take the reciprocal of the 10-year treasury yield, you get a pretty good estimate of the true S&P 500 value. So I think the reciprocal of 4.6 is around 22-ish. Which means that right now the S&P 500 is largely overvalued. So you may be wondering again, how do we how do we test for the how do we know the market direction? Well, we use this long-term investment model in the Hoperation Fund to find the long-term direction of the market. Here is a screenshot of the backtesting of the investment model to determine the long-term criteria. The blue line is our long-term model and SPY, and the orange line is SPY. You can see while these two have around similar returns, the long-term model has very less fluctuations, right? It avoids a lot of SPYs, drawdowns and losses. So you can see here, the standard deviation of our long-term model is 10.7%, while the standard deviation of SPY is 15%. The worst year is also negative 19.87%, and while the worst year of SPY is negative 36.81%. The max drawdown is also significantly less. So, oh, by the way, if some of you don't know what things such as the standard deviation or max drawdown are, or the Sharpe ratio, these are basically metrics to determine like the stability of a stock. I will also explain that next time. So now, where are we on our stock market and economy stages? This, of course, there's no like exact right or wrong answer, but I believe we're around this part. So in the mid-expansion of economy to mid-bull market stage. Notice though, however, while we are in the mid-bull market, since the S&P 500 is still largely overvalued, I wouldn't be too surprised or panicky if the stock market experienced some minor losses or minor crashes. And now let's move on to today's investment lecture. This will be our 5th investment lecture. Today I will go through an open discussion where we will each share our ETF portfolios. Then I will talk about bonds and bond ETFs. And if we have time, I will do a case study on Warren Buffett's 90-10 portfolio. So now let's go on to share our ETF portfolios. Remember last time I gave you guys an assignment where everyone had to go through the 3 steps I mentioned last time. Number 1, find your market directions. Number 2, pick the ETFs that are suitable for each market direction. And number 3, decide for which ETF how much of your portfolio's capital it is going to take up. So now let's go on to today's investment lecture. Today we're going to be talking about bonds. So what are bonds? A bond is basically a loan made by an investor to a borrower. The borrower typically is a company or like a government. It is a fixed income investment where the borrower, like the company or the government, pays regular interest to the investor and repays the principal amount that the investor lent to the borrower at maturity. So there's some terms here, and I'm going to go over some terms and key features of bonds that you may not recognize. So the first key feature of a bond is its face value. The face value is the amount of money a bondholder will receive from the bond issuer when the bond matures. It basically represents the principal amount of the loan that the bondholder or the investor initially gave to the issuer. It is fixed throughout the bond's life. The coupon rate is the interest rate that the issuer pays to the bondholder. The rate is fixed for the life of the bond, providing the bondholder with a predictable, steady income stream. Then there's the bond price, or the market price, sometimes it's called. The bond or market price is the amount buyers in the market are willing to pay for the bond, and it fluctuates due to many factors, such as the central bank's interest rates, credit risk, and supply and demand. We will talk about this in later slides too today. Then there's the bond yield. That's the annualized coupon payment in terms of the coupon rate and face value. The bond yield is basically equal to the coupon rate, which is the interest rate that the borrower pays to the investor times the face value divided by the current market price of the bond. Note that the bond yield times the bond price is a fixed value. It's equal to the coupon rate times the face value, and the face value and the coupon rate always stay the same, which means that the bond price and the bond yield has an inverse relationship. When the bond price increases, the bond yield, which is a percentage, decreases, and when the bond price decreases, the bond yield will increase. Then there's a maturity date. Bonds have a maturity date, which is the date when the borrower or the bond issuer agrees to repay the amount of money they borrowed to the investor. This provides the bondholder with a clear timeline for their investment. And finally, there's the credit rating. Bonds are typically given a credit rating by independent credit rating agencies, and this rating reflects the bond issuer's ability to repay the bond. We will also talk more about credit ratings later. But for now, the four main terms you need to know are the face value, the amount of money a bondholder or investor paid or will receive from the bond issuer. It also represents the principal amount of the loan that the bondholder initially paid to the issuer. Then the market price, which is the amount that buyers are willing to pay for the bond. The coupon rate, which is the interest rate that the issuer pays to the bondholder, and this rate is fixed. And then there's the yield, the annualized coupon payment in terms of the coupon rate and face value. So the coupon rate doesn't change, but the yield will. So I'm just gonna go over two examples so you guys can understand this, because I know this is really confusing. Example one is like this. If a bond has a face value of $1,000 and a 5% coupon rate, it pays $50 per year, right? Because 5% times $1,000 is $50. So say it's like a 3-year bond, and its face value is $1,000. It has a coupon rate of 5%. Then every year you will get $50. And at the end of 3 years, you will get the $1,000 back. Example number 2 is if the current market price of the above bond is $950. Say we have this bond here, as in example 1, but its market price, which is the amount other people are willing to pay for that bond, is $950. Then its yield is $50, which is the coupon rate here, times the face value here, which equals $50, divided by $950, which is the market price. then the yield is 5.26%. Basically, you can think of it like a return. Like when you invest in stocks, let's say you invest in the SPY, right? If you get a return of like a yield to a bond is basically like the returns of a stock, kind of, to the stock. So the yield is basically the return in percentage that you get each year in terms of in terms of like the coupon rate and the face value and the current market price. So does anyone have any questions so far? Okay. So now let's do a game. According to the bond figure here, this is a picture of an old bond, I think in like 1976 or something. So does anyone know what's the face value of this bond? Can if you have the answer, just you can say that loud, or in the chat. Yeah, Arya said 5,000. Minya Shen said 5,000. Yeah, the face. Yeah, great. The face value is $5,000. So basically, that's the amount of money you get after the maturity of the bond. So what's the coupon rate then? Can you guys find the coupon rate? Okay, Arya said 8%. Does anyone else have any other ideas? Sebastian? Okay, 8% or off 8%. Yeah. The the coupon rate of this bond is 8%, which means every year you will get 8% times $5,000. Okay, so now finally, what's the maturity date of this bond? Does anyone know what the, like, can anyone see what's the maturity date of this bond? Okay. Okay. Angela said the maturity is August 15, 1986. Yeah. The maturity date is actually August 15, 1986. And so, by the way, make sure not to get mixed up. This figure here, August 16, 1976, is the date, like it was made basically, and August 15, 1986 is the maturity date of this bond. Okay, and finally, you guys can just like blurt this out loud. This should be kind of obvious. So who issued this bond? Okay, Secretary of the Treasury, kind of. Does anyone know who issued this bond? Okay, yeah, the U.S. government. You can see her. The person who issued this bond, like the government, like the corporation which issued this bond is the United States of America government. But, like the signature here is like the Secretary of the Treasury. Okay. So now, does anyone have any more questions about like face values, coupon rates, maturity dates, yields, etc.? It's okay if you have like any questions, because this material is kind of confusing. Hmm. Okay, I'll let you guys look at this for a moment. Okay. So now let's talk about bond ratings. So a bond rating is basically a rating that companies such as like Moody's make. It basically tells you how likely a bond issuer or the borrower is, how likely they will return the money to you. So the ratings go from AAA to like D. You can see this like AAA, AAA, BBB, B, BBB, the C's, etc. So the risk level goes from the AAs to the D ratings, or like here it's the C ratings. The AAA ratings here have the lowest risk. So those bonds who have those ratings are most likely to pay you back, and there is the lowest risk. Meanwhile, AA has low risk but slightly higher risk than AAA ratings. Then A ratings have still low risk but higher risks than AA ratings. And then there's BBB, which has medium risk. Then there's BB, there's the lower B's and C's. So the ratings here in this section are called investment grades. So those are basically good grades to invest in. Meanwhile, the other grades are called junk grades. They're not actually junk, but they're like bonds that have a low chance to pay you back before they like go bankrupt. Generally, though, like for bonds with higher ratings, they give you lower returns or lower coupon rates and yields, while junk bonds or bonds with lower ratings will give you higher yields or higher coupon rates to make their bonds more appealing. So I think Arya had a question.
Why would anyone invest in like the junk grade bond ratings if it has such high risk?
Well, generally, most people try to invest in investment grades. I think there was this one investor who specialized in investing in junk bonds, like in good junk bonds. Like he would pick through all the junk bonds, find like bonds that he thought wouldn't be likely to go bankrupt and invest in those since they had higher returns. But generally, the vast majority of people invest in investment grade bonds. So yeah, basically no one invests in junk bonds, is what I'm trying to say. But like these ratings are just there to like help investors like figure out what type of bond they're investing in. William said a question, aren't most bonds issued by the government which will always be returned? Uh, a lot of bonds are issued by the government which will always be returned. Like I think the US Treasury bonds are AAA, or it might be AA. Like the US Treasury bonds I think are AAA, but a lot of corporate bonds are in like the lower categories. For example, could you give me an example of a junk bond or an issuer of a junk bond? I think Tesla, for example. I think Tesla has a junk bond. I'm not 100% sure, but I think I heard before that Tesla has a junk bond. For example, but like you don't need like a specific example. Generally, some companies, like a lot of companies, they they make bonds to raise money, right? So some of those companies might be at the edge of bankruptcy. Like they might have very low money and they might be almost going bankrupt, which is why they're making bonds. Oh yeah, Tesla's bond once was rated as a junk bond. Yeah. So those companies that have like unstable financials, they will issue bonds and those bonds may sometimes be rated as junk bonds. Okay, so does anyone have any more questions on this? Okay, so there's three main types of bonds. Government bonds, as I think William asked about, those are issued by national governments, for example, US Treasury bonds. Corporate bonds, which are issued by companies to raise capital, and municipal bonds, which are issued by local governments for public projects. For example, bonds issued by Dallas County are municipal bonds. So now, you guys might be asking a question: why would anyone invest in bonds? Well, there are some benefits of bonds. For example, bonds have steady income. Investors can receive regular interest payment, for example, every year or sometimes every like quarters or a period of time. Bonds also have lower risk and less volatility relative to stocks. The two main risks with bonds, I think, are if the bond issuer goes bankrupt and won't pay you back, or if there's too much inflation, which would lower your returns. But bonds have very low risk compared to stocks. There's also portfolio diversification. Bonds can hedge against stocks' risks and reduce the overall risk in investment portfolios. Some limitations of bonds, though, are that they have lower returns, and generally they're not a good investment in high inflation environments. I will talk about this later. But here you can see I plotted the graphs of the iShares 1 to 3 year treasury bonds, the iShares 3 to 7 years treasury bond, the iShares 20 plus year treasury bonds, and the Vanguard 500 index investor. You can see that iShares 1 to 3 year and 3 to 7 year bonds are very smooth. Like the graphs are almost like you can see here, it's almost like a straight line. So they have very low volatility. Of course, you can't say that for the 20 plus year, but like, yeah, Arya?
Yeah, so why would you, if bonds have less risk compared to stocks? I remember last class you said to invest more in stocks and bonds. But why is it a better idea to invest in stocks and bonds?
Okay, so some people, like a lot of like elder people or people like in retirement or people like who can't take much risk, they were like bonds because bonds like that's a really good question actually. Because bonds they give like very steady income, right? Every year they give you a regular interest. And if you buy like very low risk, high rating stock, like high rating bonds, then there's again very low risk. So those bonds are ideal for bonds like are ideal for like for elderly or like for retired people. Um, Bonds also hedge against stocks risk. Um, so like they're good in like bad stock markets where like just like stocks go down and like bonds will still keep on like going up. But like last meeting or last class, I said we should invest in stocks mainly because while stocks have high volatility, they have like really high profits, right? So, and especially since like over the long term, if you hold like, for example, uh, not even a stock, like an ETF, like SPY for a long time, then like the volatile, then like you will still get like super high returns. So generally, I would recommend investing in stocks in like good stock markets where like stocks are like the stock market is going up or like you think the stock will go up. That's why in like good in like bullish markets, I would recommend investing in stocks more than bonds because if you have like if the stocks are going up a lot and you just have like bonds which are going really steady, then I would like it makes sense to invest in stocks more, right? Also, by the way, let me clear all the annotations. Um Also, since we're like kids and we don't have to worry so much about like paying mortgage rates for like your houses or like living off of your money, it's good like it's good if we mostly focus on like long-term investing. Since we're kids, we have a lot of time and we don't have to worry about paying for like our living costs. So I would recommend like investing more in like stocks. So does that answer your question? Uh, Arya? So yeah, that's my answer. Does that answer your question? Okay. Yeah, that's a good question though. Also, and if you guys have any questions, you guys can feel free to ask me. But now I'll continue. So previously I said that bonds are generally not a good investment in high inflation environments. So why is this? Most people, when they invest in bonds though, they want to hedge against the stock market. Like if the stock market is going down, they want bonds to like hedge against stocks. So persistently though, high inflation has been associated with positive equity bond correlations, like positive correlations between stock prices and bond prices. So as you can see from this visualization here, the y-axis shows the 5-year equity bond correlation, and the y-axis shows the 5-year equity bond correlation, and the x-axis shows the 5-year annual inflation percentage rates. Uh, so assuming you guys know about like correlation, you can see this dotted line here, right? This dotted line marks the threshold where the 5-year annual inflation percentage is 3. For years when the 5-year annual inflation percentage is under 3, which is over here. Can you guys see my laser pointer? Over here, the equity bond correlation is generally around 0 or less than 0. You can see this majority is over here. Meanwhile, when the annual inflation percentage is greater than 3, like over here, you can see that the equity bond correlation is always above 0 or positive. So what this means is that when there's a positive equity bond correlation, when the stock market goes up, the bonds will go up too. Or when the stock market goes down, then bonds would go down. Well, most people don't want that because that would ruin the point of bonds sometimes. Since most people want bonds to hedge against the stock market, like when the stock market goes down, bonds go up, then that wouldn't be a very good idea. So that's just a note to make. When inflation rates are above 3%, bonds cannot hedge against stocks. And the final concept I want to talk about today, we're going a little bit over time, so I'll go through this quickly, is that bond prices are inversely related to interest rates. When interest rates go up, note that the interest rates are like central bank interest rates. Like when you deposit money into a bank and the bank gives you interest rates, those are the interest rates I'm talking about. So bond prices are inversely related to interest rates. And this makes sense, right? When interest rates go up, then bond prices will decrease and bond yields increase. Because when interest rates go up, then the bond issuers or the people who want to borrow money using bonds, they will adjust the prices of their bonds to ensure that their yields will remain competitive with current market interest rates. Because if you had the choice between depositing, if like bank interest rates and bond interest rate, like bond yields were the same, then most people would put their money in banks, right? So then bond makers would have to decrease the prices of those bonds so that investors will find your bonds more attractive or appealing. Therefore, if the prices of the bonds decrease, then the bond yields will increase. And if interest rates fall, then the bond prices will increase and bond yields will decrease. And finally, what are bond ETFs then? So, because we've heard of like stock ETFs, right? Well, bond ETFs are kind of similar. They are an exchange-traded funds which hold a diversified portfolio of bonds instead of stocks. And they are usually traded like a stock or a stock ETF. Some advantages are that they are very diversified, like they spread risk across many types of bonds. They also have high liquidity. They are easier to buy and sell compared to individual bonds. And finally, they have low cost. They have lower fees than actively managed bond mutual funds. So we will talk about bond ETFs more in next meeting. And we don't have time. We obviously don't have time for our uh case study though. But now I'm gonna talk about this meeting's homework. Bond prices refer to its market price, like how much people are willing to pay for a bond. So say you have like a bond with like a $1,000 face value. Sometimes the market price can go below the face value. So like maybe if it's $900, then you're basically paying. Then you can buy a $1,000 face value bond for $900, which would be better than paying $1,000, right? As for $900, you get the $1,000 plus interest plus like coupon rates. So now the homework for this meeting is to read the following articles, because next meeting we will talk about Warren Buffett's 90-10 asset allocation strategy or investing strategy. So read the following articles, think about what are the pros and cons of this strategy, and who is suitable for this strategy. Next meeting, after you guys have read the following articles, we will go on to discuss Warren Buffett's 90-10 asset allocation. Okay. And again, if you think these meetings are helpful to you, please introduce the Hoperation Fund to your friends. I can copy these links in the chat. Arya, do you have a question? Oh, okay. My dad already.
I was wondering, how long will these recordings for these classes, how long will they be available for?
Well, I think these recordings will be available for about a year or so, but we also post meetings on YouTube too, I think. I don't know. If you have more questions about the I'm not really sure about how long these recordings will uh like be there, but after this meeting I'll go like look and see, and if and then I'll just email you. I think we do post these meetings on YouTube though, or at least some. Okay. So does that
Okay,
answer?
thank you. Yeah.
Okay. And so anyways, thank you guys all for coming. If you think these meetings are helpful to you, please introduce the Hoperation Fund to your friends. Okay, thank you. Thank you all for coming. Have a good evening and a great year, and bye.
Thank you.